Most homeowners in retirement are focused on the wrong number when they plan their home sale. They run the gain and get excited, but the timing of this sale can really set them back. They think they've done the math and got everything figured out, but there's a Medicare bill coming for them 2 years later down the road that nobody warned them about. It's called IRMAA, the Income Related Monthly Adjustment Amount, or IRMAA. And if you bought your home 15, 20, even 25 years ago, whether you're here in Utah or anywhere else in the country, there's a very good chance you've never heard this word. Sell your home without understanding IRMAA, and Medicare can quietly raise your premiums for the next 2 years. That can be a very expensive mistake. In the next 9 minutes, here's exactly what I'm going to show you. What IRMAA is and how the 2-year lookback works. How your home sale triggers it. What the real numbers from the 2026 thresholds are. And what you can actually do to protect yourself, including one option most financial advisors never think to mention. Stay to the end. The last one is the one that people miss the most. All right, let's start with the basics. Most people know that Medicare isn't free. Part B, that part that covers your doctor visits and outpatient care, has a standard monthly premium. For 2026, that's $185 a month per person. But here's what most people don't know. Medicare doesn't charge everyone the same amount. If your income is above a certain level, they charge you more, sometimes significantly more. That extra charge is IRMAA. Now, for most retirees, predictable income, Social Security, a pension, some dividends, this usually isn't a problem. Here's where the trap is though. Medicare doesn't look at your income right now. They use a 2-year look back. Your 2026 Medicare premiums are based on what's on your 2024 tax return. The 2-year lag is where people get blindsided because if something big happened to you, income in 2024, and I mean something like selling your home, Medicare sees it 2 years later and they come for you. And you don't get a warning letter first. The bill just shows up. So now you know what IRMAA is and how the 2-year look back actually works. But here's where it gets real. And I'm going to show you exactly how a typical home sale crosses that line with actual 2026 numbers and what it looks like on your Medicare bill. So let's talk about how this plays out in real life. When you sell your home, the IRS treats your profit as income. Now, the good news, there is a primary residence exclusion, $250,000 if you're single, $500,000 if you're married, filing jointly, and you've lived in your home at least 2 of the last 5 years. You can exclude that amount from your taxable gain. That's great. That really helps. But here in Utah, a lot of homeowners bought their homes 15 to 25 years ago, and values have gone up a lot since then. Let me show you an example. John and Karen bought their home in Draper for $300,000 20 years ago. Today, they sell it for $1.1 million. That's an $800,000 gain. Great for them. They're married, so they get the $500,000 exclusion. Good. That leaves $300,000 that hits their modified adjusted gross income, or MAGI, for 2024. Now look at the IRMAA thresholds for 2026. Single, IRMAA kicks in above 109,000 MAGI. Married, filing jointly, IRMAA kicks in above 218,000 MAGI. At the highest income tier, Medicare can add $628 per month per person on top of their standard premium. That's for Part B alone. 2 people, 2 years, do the math, over $30,000. And here's the line I need you to remember. Going over these thresholds by even $1 triggers a surcharge. Not a percentage, not a sliding scale, a cliff. $1 over, and you're in. I want to stop here for a second and tell you something from my own personal experience. Over 25 years, I've helped hundreds of families sell their homes right here in Utah. I can count on one hand how many of those families before we had this conversation knew what IRMAA was. Not because they weren't smart, not because they didn't have a CPA, but because nobody connected the dots between the home sale and the Medicare bill. I have never heard one other real estate agent warn their clients about this rule. I had a couple longtime homeowners here in Highland. They were in a beautiful home, very smart couple, great CPA. They knew about the gain, they knew about the exclusion, but when we walked through what their Medicare premiums were going to look like for the 2 years after the sale, there was a long pause at the table. Nobody had told them. That's not an unusual conversation in my world. It's actually one of the most common ones. You can make your own decision with your eyes wide open. but only if somebody gives you the whole picture and the information before the sign goes in the yard. All right, so now you know what IRMAA is. You know how the home sale triggers it, and you've seen how fast you can cross that cliff. Here's the good news. There are 5 specific things you can do to protect yourself. And I promise you, option number 3 is something most financial advisors have never even mentioned to their clients. So let's go over them. Option 1, time the sale strategically. If you have flexibility on when you sell, think carefully about your income in the year of the sale. If you can close in a year where your other income is lower, before a required minimum distribution kicks in, or before you start Social Security, you give yourself more runway under the IRMAA threshold. Talk to your CPA about this before you list, not after. After is too late. Option 2, the installment sale. In some situations, you can structure the sale so the buyer pays you over multiple years instead of all at once. That spreads the capital gain across 2 years, which can keep you under the IRMAA threshold in both years. Not every situation qualifies, but it's worth the conversation with your CPA to see if your situation will work out for you. Option number 3, and this is the one that most people never hear about, the IRMAA appeal. If you experience a life-changing event, you can appeal your IRMAA surcharge using a form called the SSA-44. And here's the important part. Retirement itself qualifies as a life-changing event. That means if you retired in 2024 and your income dropped significantly, but Medicare is still looking at your 2022 income and you were still working, you can appeal. You may be able to reduce or eliminate the surcharge. Most people don't know this form even exists, but now you do. Option 4, coordinate your Roth conversions. A lot of retirees do Roth conversions before Medicare kicks in. That's smart planning. But if you're also selling your home in that same window, you can accidentally stack capital gains on top of conversion income and push yourself into the top IRMAA tier without realizing it. Your financial planner and your CPA need to be talking to each other. If they're not, that can be a very expensive mistake. And option 5, run the full math before you list. I built a retirement state cost calculator specifically for situations like this. If you're thinking about selling and possibly relocating to a different state, and a lot of my clients are, this calculator lets you model the real numbers, taxes, Medicare impact, cost of living, all of it side by side. The link is down in the description below. It's completely free, no email to put in. I'm not going to spam you, nothing like that. Go and check it out. It might be helpful to you. Make sure you do the full math, not the hopeful math, but the real math, because these things really matter. And a quick disclaimer before I close, I'm a Utah real estate broker, not a CPA, not a financial advisor. Everything I've shared today is educational. Your situation is unique. Please work with a qualified CPA and a financial planner before making any decisions around the timing of your home sale. What I can tell you from 25 plus years of watching families navigate exactly these decisions is that the people who avoid this mistake have one thing in common. They had this conversation before the sign went in the yard, not after. And let me say this clearly, this is not a small decision. Done without the right information, this can have a major impact on your retirement and cost you $20,000 or $30,000 or maybe even more. If you're actually running these numbers for yourself and want a second set of eyes on it, I'm happy to spend 15 minutes with you. No charge, no obligation. There's a link in the description down below. I'll walk you through your specific situation, the home sale, the IRMAA math, the timing. I've been doing this for 25 plus years, and I'll share everything I've gathered and learned. I'm actually going through the same timing and situation myself, so I want to make sure you're aware of this. If this information has been helpful, please remember to hit the like and subscribe button so more Utah homeowners and other homeowners throughout the country get this information before they need it, not after. And let me know in the comments below, did you know about this rule or did you sell already and didn't know about it? If so, remember your IRMAA appeal form I told you about. If you're wondering which state has the lowest taxes for retirement, watch this video I have right here. Until the next time, remember, please stay safe, my friends.